Nxumalo. My name is Mpho Mtsi, and I'm very excited today to welcome you to the first of our regular reflections that we have with the experts in our business. And I'm joined today by our Chief Investment Officer, Siboniso Nxumalo. I'm very excited for you to kick off the year with some of your insights and important observations for the year ahead. So let's start. 2024 was a dynamic year, to say the least. We had elections in 65 countries, including our own, lingering inflation concerns. Of course, that also has an impact on the interest rate debates, all sorts of geopolitical uncertainty. So with that backdrop, perhaps you could give us an idea of some of the key trends that you think are going to be driving markets in 2025.
Yes. Hi to the listeners. And Paul, the way we look at the market is let's look at what happened and what that positions us for in 2025. Like you've said, a big year for elections last year, of which the last election was the most material one. We're going to touch on that when we look at the US elections and the subsequent impact of that. But when we look at the year, you had the US driving returns. And the US market closed around 24.5% up. 7 stocks drove 67% returns, being the Magnificent Seven. They drove the vast majority of returns. And actually, at the moment, we are in a situation where the US market, the S&P 500, is at the most concentrated it's been since the 1960s, using what's called an HHI measure. And so therefore, you've got a very narrow market, as in it's driven by few companies known as the Magnificent Seven. These are the Teslas, the Microsoft, the Apples, Alphabet, Google, Meta, which owns, and NVIDIA, which has obviously been the stellar performer. So those companies have generally driven the market to an astonishing level. And so therefore, the US market is priced for perfection. It is looking very expensive. It's looking richly priced. And it's the biggest market in the world. Very concentrated. So for us, we're nervous. When we look at the other side, the second biggest economy in the world, which is China, China has gone the opposite way. The Chinese market has been disappointing to the global economy and actually been disappointing to the world. Why? China is suffering from what's called the 3 Ds. High debt levels, deflation, and then weak demographics. And so we saw a weakness in the Chinese economies. In fact, we saw some growth spurts as the world is expecting the Chinese government to give some form of stimulus, but that didn't materialize. And so therefore, as we close off the year, especially with the election of Trump, there were worries out there. And so then we come to South Africa. South Africa started off with lots of anxiety before the election. The election came, a positive outcome, successful. Then we had a rally in South Africa. But South Africa is an emerging market, which is then susceptible to the vagrants of the world. Trump came in and emerging markets underperformed because Trump was going to put tariffs and all of that. And so that's where the world is. And so therefore, as we then start looking forward, you've got a very expensive and narrow US market. And so therefore, whatever happens there is going to affect the global returns. And then you've got a very cheap China with lots of issues as to why it is cheap, but we're seeing value in China. And then you've got South Africa, which is also looking very attractively priced. So there's lots of value in South Africa, especially the more cyclical elements of South Africa. And yet it's just struggling to get going. And so therefore, that's how we are looking at the world. That's what's going to determine returns for 2025.
Thank you for that. Yeah, great picture that you've created. And I want us to unpack certain elements of it a little bit more. And then I want us to get down to like specific stocks, etc. And of course, the OMEG portfolios. But I think let's start by just discussing a little bit more on the interest rates. Obviously, we know just how much they drive economic growth, investment returns. It's an important component of what you're thinking of as a team, as you're constructing portfolios. So what really is the OMEG view on interest rates in 2025?
So let's start with the Fed. The federal government, the US central bank, because their interest rate tends to lead the market and everybody else tends to follow, especially South Africa. And so what we saw in 2024 was that the world had priced in actually that there were going to be several interest rate cuts in the US, and we started seeing some of those cuts. And so in South Africa, then we just simply followed in terms of the cuts, especially in terms of the magnitude of those cuts. And interest rate cuts then obviously put more money in consumers and lower borrowing costs, and then are good for economies and company earnings and obviously personal incomes. What we ended up seeing, though, was that what the expectations at the beginning of 2024 actually did not materialize. We did not have the magnitude of the interest rate cuts that were anticipated. And so, therefore, that leaves us in an interesting space because the Trump policies are very inflationary. Inflation still looks pretty sticky. And so, therefore, there's nervousness and tension, and the markets are a bit worried about actually, are we going to get interest rate cuts? When you come back to South Africa is actually at a very interesting spot. The Reserve Bank of South Africa is extremely cautious when it comes to interest rates. And in fact, if you look at real rates, South Africa is in South Africa's inflation is just under 2%. That's according to the recent print. So it's extremely low. And yet our interest rates remain extremely high. We think that, and there's been a lot of commentary in the market about how our interest rates are prohibitive to growth, that the SARB needs to be a little bit more aggressive and provide the economy with some form of stimulus and juice, because even if you look forward, inflation, yes, will start ticking up, but actually not as materially. And so therefore, South African rates, we think, should be cut. But whether the South African Reserve Bank will cut ahead materially of the Fed, that's highly unlikely. So therefore, we think interest rates are a little bit restrictive in South Africa, and the economy probably needs a little bit more. So that's how we see the interest rate landscape.
And I mean, you already touched on China and, of course, Trump. We know the inauguration's next week. And China had the stimulus that they provided end of last year and second half of last year, trying to revive the economy. So perhaps you could just delve a little bit deeper into that from a portfolio construction perspective as well. Just on these two big economies that we know if they sneeze, we catch a cold. So perhaps if you could just give us a bit more color on that. And also, even just taking a step back and in general, DM versus EM, what are some of the considerations at this?
Yes. So if we look at let's start with the US. And I think the US is obviously the largest market. So if you go offshore, when you look at a benchmark like MSCI Equi, All Country World Index, the US is close to 70% of that particular benchmark. So global returns are largely driven by the US. And as I've said, narrow market, few shares, very, very concentrated. And so therefore, if those shares show any sign of weakness, that's going to impact global returns. So from our perspective, it's very difficult to find value in those shares. We think that those shares are priced for perfection. Yes, AI is real. Yes, all of this technological advancements is real. But actually, the market here is probably gone ahead of itself. And so therefore, we are nervous in terms of US returns. China, on the other hand, like I've said, is on the other side of it, is that Chinese multiples are very low. So Chinese, actually, that is looking very attractive relative, especially to the US. And so therefore, when you look at China, and obviously we can access China through buying commodities, but also through buying Naspers and Richemont, et cetera, et cetera. And when we look at the underlying fundamentals of Richemont, of Naspers, etc., those fundamentals are actually attractive to us. Hence, we own them in the portfolios, and we actually own sizable amounts of those names, because actually we think that China at some point will, yes, I think the government did try a few stimulus a few times, but actually, it hasn't quite landed yet. But those companies are generating returns, they're generating growth. And for us, as long as that happens, at some point, the market will reward them. So that's how we look at that. We've got a dislocation between the two largest economies. One is extremely cheap and one is extremely expensive. And I think the one point to say is that China has also got, obviously, a tech industry that is also investing in terms of AI, et cetera, et cetera. And in fact, if you look at patents that were, I think, signed up last year in terms of AI, I think quite a lot of them came from China. And yet the Chinese tech names of us, we can have exposure to Naspers, which owns Tencent, but if you look at the Alibabas and Baidus, et cetera, actually, these companies are doing something similar to the US, but they're not priced at the same multiples. And so for us, I think there's a lot of value in the Chinese industry. And the last bit, again, if I come back to Naspers, Naspers changed management in 2024. A wholesale change. I should look at their exco and their management. And when we start paying attention to what the new management is doing, their capital allocation, their decision making, actually that is looking like these guys are focused on shareholder value creation. for us as investors, that's what we need to do for our clients. And so, therefore, that's why that is one of our biggest positions. So it is our biggest position, but one of our biggest tilts in the market. And so, therefore, optimistic on that one.
And I guess you also touched on SA Inc. But I'm curious to know, some of your favorite stocks at the moment and why. OMIG as a house, we were very positive on SA stocks last year. Do we still see value at this point in time? And perhaps if you could just unpack for us sector by sector.
Yeah. So we see a lot of value in SA Inc. Why? Because I think you've got to take a step back and say, okay, what happened in South Africa? I think start of the year, lots of nerves, elections, the GNUs come in. With the GNU coming in, all of a sudden, you have seen a lot more stability in terms of government. But also, you're starting to hear noises that are good in terms of execution. The government is dealing with things. It looks like things are being done. I mean, the most obvious one being I suppose, ESCOM, in that actually the lights are on. And now it's normal that the lights are on. And so for us, we're saying, hey, the underlying fundamentals of the country are actually heading in the right direction. And obviously, we're saying interest rates are too high, which means the direction of interest rates. Now, we don't know when these will happen or to what extent, but actually, the direction is that interest rates will reduce. And so, therefore, in South Africa, we are overweight the cyclical names. So, mainly then, that is banks and retailers. So in terms of banks, we're looking at a company like First Rand, which obviously is made up of RMB, FNB, and Westbank. And so though that particular bank, which is a high quality business that actually continues to earn very high returns, and that is, we think, is attractively priced, especially given where bond yields in South Africa are. So South African banks are very attractive to us. Another one, say Standard Bank. Again, we avoid Standard Bank. Standard Bank has done an extraordinary job in building a strong banking franchise in Africa. It's the strongest banking franchise in Africa. And actually, Africa is also starting to recover. So if you look at the performance of Standard Bank, a large part of this has been driven by extracting great returns and great earnings growth in Africa. And so for us, we're attracted to that. And then you come to the retailers, which then you look at Mr. Price, Pep, and Foschini. We own all of those names. And again, as interest rates started coming down, the market priced those particular companies. So I think we saw the banks returning around 17, 18% last year, which is pretty good. And then we saw the retailers doing around 34% last year, which again is a pleasant returns. So in South Africa, we're saying, hey, the consumer is going to get healthier, the economy is going to get healthier, and so therefore, and interest rates are going to help support this. And so therefore, if that's the case, then we need to be in the most cyclical names, and these are the ones that will benefit the most from a better economy. And I think the last comment is that as a long-term investor, you've got to realize that South Africa hasn't grown in probably a decade. If you look at the GDP per capita, consumers haven't gotten wealthier because we've just gotten in our own way. And so therefore, there are few things that need to happen right for South African shares to start showing earnings growth. So far, they've managed costs extremely well, which means there's a lot of operating leverage, which means if you add just a little bit of growth, actually you're going to get an expansion on that. And so I'm optimistic on South Africa.
So tell me then, in the previous quarter that ended end of December, how did the OMIG funds perform? And perhaps if you could just share just some of the key drivers and detractors as well. And yeah, I mean, we've seen, just you already mentioned how internationally the S&P 500 performed, etc. The impact of this very narrow market. So what has been that impact on our funds?
So I'm going to start with our multi-asset funds. Now, remember the context. So in investing, positioning precedes performance. So how you're positioned determines how you perform. And so when we looked at that, we said, okay, we are underweight. For the vast majority, they were underweight the US. And so therefore, the US was super strong. Okay, that wasn't then good for our performance. We're overweight South Africa, which worked well up until the beginning of Q4 when Trump mania then took over. And so obviously we're overweight in China, and China's obviously struggling. So for us, we have clearly said, where is their value? We've positioned ourselves there, but actually the market isn't quite recognizing that yet. So obviously we've got faith that in 2025, our work is telling us that, hey, this will be recognized over a reasonable time period. So therefore, our funds tended to struggle. actually on the especially in the last quarter. I think from Q2, Q3, our funds actually were doing fine. But Q3, Q4, our funds really struggled. And so therefore, especially the active ones are mostly third quartile and some fourth quartile. Reflecting that our positioning wasn't actually suitable in terms of what worked. And a large part of that is actually when Trump came in, the dollar got stronger, which means our commodities got weaker, emerging markets got weaker, and that's where our positioning is. And so actually that hasn't quite worked out yet. But again, we learned lessons from Trump was first elected in 2016. In the sense back then, this exact same thing happened. The Trump came in, the dollar got stronger, the US market got stronger. But actually, by the time he got elected, inaugurated, that had kind of finished this rally and they started going the other way. And so from our perspective, saying, hey, actually, let's hold on to our positions. We believe in these companies. We've done our work. And so those funds then struggled. A notable fund to mention is the Old Mutual Flexible Fund. That one is first quartile in terms of our performance in this particular quarter. So very strong performance. And then if we look at what we call our core indexation range, again, the consistency of that range has been really amazing. I think they were all second quartile in this particular quarter. So that was pleasing to see, especially if you look at it on a longer term, then actually that core range, core balance, core conservative, and core moderate, those funds are second, first quartile, I think between 1 and 5 years. And so again, that's pleasing to see. And the last one I'm going to mention, which was second quartile in the quarter, but actually over the longer term is first quartile, is our global managed alpha product, which obviously is a beneficiary of strong global markets, especially in the US, being a global fund. And so, again, we saw a mixed bag, a complicated quarter, but largely driven by what happened when Donald Trump got elected.
Awesome. And I think before we close, it'd be remiss of me not to actually touch on the impact of technological advancements. We know our clients always asking us about AI, etc. And we really know that is going to continue to be a disruptor. We've really seen it has disrupted many industries. And also then a stronger and ever growing focus on sustainability. So considering these two topics, how can investors capitalize on those trends?
Yeah, these are interesting because I mean, I think in terms of sustainability, obviously we've got a strong system and a strong organization in terms of actually what are we doing with sustainability and how we analyze companies and invest in companies. AI is an interesting trend. The one thing that is not looked at in AI is how much energy AI consumes. So turns out, yes, we're going to have technological advancement, but if you look at the amount of energy in terms of electricity that is consumed by AI, and yet the world doesn't have enough renewable energy to fund, to actually fuel all of this AI growth. So if AI takes off in the way it's anticipated, we're going to run out of electricity globally. And so therefore, that is a little bit of an interesting dichotomy. Hence, you are seeing all these old coal power stations getting turned on around globally, and there's all this debate about how you manage these tensions. And so therefore, markets are an ecosystem that has to take this part and this part together. And you've got to analyze and look at the complete picture. From our view, we think that yes, technology will continue. Obviously, AI will continue and be a disruptor. If you listen to the best and the brightest minds, which are mostly from the US, they're telling you that AI is going to be the biggest disruptor since the advance of the internet. But we've wanted to step back and go back to the 2000s when the internet was coming in and everybody said, it's going to change the world, it's going to change the world. They were right. The problem is the price you were paying for the assets that were going to change the world meant that you lost money as an investor over a long period of time. The expectations were too high. We are here today. These are better companies. These are better tech companies. But actually, you are still paying an extraordinary price in anticipation of something that hasn't quite materialized. And so from our perspective, we're looking at this and say, hey, you've got to be cautious here because if you go back 25 years, there are lessons to be learned there. So yes, will it disrupt? Yes. But I think the market has anticipated it already because markets work on what's called a variant perception. Is that if everybody anticipates and price it in, you're not going to make money out of it. You've actually got to look elsewhere in order to make money out of it. And so that's how we look at it. And then the final one, then coming back to renewables, for us, if the renewable thing is going to happen, you are going to need commodities. And in needing commodities, actually, then it's like, okay, South Africa is a mining country, it's a mining economy. And so therefore, which commodities are going to benefit? Copper. because you need to wire all of this energy. So from our side, actually, if you want to participate in an alternative way in terms of the AI boom, hey, you've got to consider where can you get access to things like copper, because if responsible investing and ESG is going to happen and AI is going to happen, actually the consumption of copper should increase materially from here on. And you can access that through companies like Anglo American in South Africa.
Thank you so much, Sibu. Always creating a very clear picture for us. I'm quite excited to see how 2025 plays out. And thanks again for joining us. I do wish you all a very prosperous 2025. And I'm really excited to see what the team with Sibu does for the OMIG portfolios. Thank you.